5. Riders and supplementary benefits. This chapter covers the most common riders and supplementary benefits that can be added to life insurance policies. While the terms riders and supplementary benefits are often used interchangeably, riders provide additional benefits upon death, and supplementary benefits provide benefits before the death of the life insured. Collectively, riders and supplementary benefits are the extras that can be added to customize a policy to better address a policyholder's unique needs. Riders and supplementary benefits are usually added at the time of issue, although sometimes they can be added to an existing contract. Most riders and supplementary benefits can apply to both term insurance and permanent insurance policies. Riders and supplementary benefits typically require the payment of additional premiums and, with the exception of the paid-up additions rider, they do not increase the policy's cash surrender value. 5.1 Riders that provide additional benefits upon death. Riders can be used to expand upon the death benefit offered by the base policy. They are discussed in the following order. Paid-up additions, PUA, rider. Term insurance riders. Accidental death, AD, rider. Guaranteed insurability benefit, GIB, rider. 5.1.1 Paid-up additions, PUA, rider. A paid-up additions, PUA, rider allows the policyholder of a whole life or universal life, UL, insurance policy to pay additional lump sum premiums to buy small amounts of paid-up permanent life insurance during the lifetime of the base policy. These PUAs increase the death benefit and the cash surrender value, CSV, of the policy. This is similar to the PUA dividend option under a participating whole life insurance policy, where policy dividends are automatically used to purchase additional amounts of paid-up insurance. The PUA rider is underwritten at the same time as the base policy, so no additional evidence of insurability is required when the policyholder purchases the PUAs. However, the insurance contract usually places limits on the rider, such as the minimum PUA that can be purchased at any one time, the maximum PUAs that can be purchased in any 1 year, the cumulative maximum PUAs that can be purchased over the life of the policy. When the policyholder can purchase PUAs, e.g., on policy anniversary, the maximum age of the life insured at the time of purchase. The minimum PUA restriction is to reduce administrative expenses associated with the purchase. The remaining restrictions ensure that the policyholder does not wait until his health fails before making a significant increase in coverage. Example: Valerie is a business professional and she is the main income earner for her family. She expects her salary to increase at a rate of 5% per year. She has a $500,000 whole life insurance policy with a PUA rider. Under this rider, she is permitted to buy additional coverage of $10,000 per year for the next 20 years, without proving her insurability, by making lump sum payments. She likes this option because she can increase her coverage as her salary increases. She is not required to purchase the additional coverage in any 1 year, but if she does not do so, she cannot carry that purchase forward, i.e., she cannot purchase $20,000 of coverage in the following year. 5.1.2 Term insurance riders. A term insurance rider adds additional coverage for death, over and above that provided by the base policy, for a limited period of time, i.e., the term. The term insurance rider can apply to the life insured under the base policy, i.e., the primary insured, or it can apply to someone else. In the latter case, the coverage on the additional person is underwritten separately from the coverage on the primary insured under the base policy. The amount of coverage on the term insurance rider is independent of the coverage provided by the base policy, and can in fact be for a greater amount. A term insurance rider cannot have a term that exceeds the term of the underlying policy. Once the base policy expires, so does the rider. If this is a concern, the policyholder should look for a term insurance rider that has a conversion option, so the rider coverage can be converted to a standalone policy upon expiry of the base policy, without having to provide proof of insurability. There are several variations of term insurance riders, as discussed below. 5.1.2.1 on a term policy. It is quite common for term insurance riders to be added to term insurance policies. For example, the family or child coverage riders discussed later in this section could be added to a term insurance policy. The primary reasons for covering these additional people with a rider instead of obtaining coverage under a separate policy are convenience and cost. By using a rider, the policyholder only has to manage a single policy, and pay one premium. It also reduces the administrative fees paid by the policyholder. The premiums for most life insurance policies include an annual policy fee, typically in the order of $50 to $100, to help cover the costs of administering the policy. The policy fee is usually a fixed sum regardless of the amount of coverage provided, and it is usually not affected by the addition of one or more riders. 5.1.2.2 on a permanent policy. Often a policyholder will have a mix of long-term and short-term insurance needs. To satisfy both needs, that person could buy some form of permanent insurance to cover the long-term needs, along with a term insurance rider to cover the shorter-term needs. Example: Zoltan is a business owner and he hopes to pass his business on to his children when he dies, but he expects that a tax liability of $500,000 will result at death. He also has a $200,000 mortgage with 10 years remaining, that he would like to have paid off if he dies. The insurance need with respect to the mortgage has a specific duration, 10 years, that could be covered with term insurance. The insurance need with respect to the business shares has no defined time limit, so permanent insurance might be appropriate. Zoltan could cover both needs by acquiring a $500,000 whole life insurance policy with a 10-year, $200,000 term insurance rider. This would be more cost-effective than paying for a $700,000 whole life insurance policy. 5.1.2.3 Family Coverage Rider. The family coverage rider is a common addition for policyholders who have a spouse and children. It is sold in units that cover all eligible family members, i.e., the spouse and all eligible children. For example, a unit might provide coverage of $5,000 for the spouse and $1,000 for each child. The insurance company normally limits the number of units that can be purchased under the rider, but that limit is usually sufficient to cover or at least offset the funeral or burial expenses the policyholder might incur upon the death of a spouse or child. The family coverage rider is underwritten based on the spouse's attained age when the rider is issued. The spousal coverage usually will not extend past a certain age, such as 65. The number of children covered under a family coverage rider does not affect the premium. Once the rider is in place, every child in the family, including adopted children, is automatically covered once they reach 15 days of age, without any increase in the premium. Death during the first 2 weeks of life is not covered under this rider. The coverage usually continues until the child reaches a certain age, such as 21 or 25. Example, cont. Valerie's husband, Robert, is a stay-at-home father, taking care of their 2-year-old twins, Rebecca and Charlotte. Valerie is currently 7 months pregnant, but she intends to return to work 4 months after giving birth. Robert's role as caregiver is essential to the financial health of the family, particularly until the children are in school full-time, so Valerie added a family coverage rider to her whole life policy, for $100,000 of term coverage on Robert, and $20,000 of coverage on each of Rebecca and Charlotte. When their son is born in a few months, he will automatically be covered for $20,000 under the rider once he reaches 15 days old, and Valerie's premium will not increase. 5.1.2.4 Child Coverage Rider. If the policyholder wants to obtain coverage for his children, but he does not have a spouse, or does not want to obtain coverage for his spouse, he can add a child coverage rider to his individual insurance policy. Like the family coverage rider, every child is automatically covered once they reach 15 days of age, without any increase in the premium, and coverage continues to a specific age, such as 21 or 25. The amount of child coverage is limited to the maximum specified by the rider. The death benefit can be used to offset the funeral or burial costs the policyholder may incur upon the child's death, or for other purposes. 5.1.2.5 Converting child or family coverage riders. A child who is covered under a child or family coverage rider usually has the option of converting that coverage to individual permanent life insurance. The option is usually available at any time while the rider is in effect, up until coverage under the rider expires. The child does not have to provide proof of insurability. Some riders allow the child to obtain up to 5 times as much coverage as that provided by the rider itself. The premium for the individual coverage will be based on the child's attained age when the new policy is issued. Example, cont. The family coverage rider on Valerie's policy will cover each child until age 25. And it gives each child the right to convert the term coverage to a whole life policy with a face amount of up to 5 times the term coverage, or $100,000, without providing proof of insurability. Rebecca has a congenital heart defect that increases her risk of premature death. As long as Rebecca acts before the term insurance coverage expires at age 25, she can still obtain $100,000 of whole life coverage even though she may otherwise be uninsurable. This same conversion option is usually available to a spouse who is insured under a family coverage rider, although the coverage amount will probably be restricted to the amount covered under the rider. 5.1.3 Accidental Death, AD, Rider. A life insurance policy with an accidental death, AD, rider will provide an extra benefit, over and above the regular death benefit, if the life insured dies as a result of an accident. Depending on the insurance company, AD rider coverage may be offered in units, e.g., in multiples of $25,000, to a specified maximum, or it may be a multiple of the death benefit. The most common multiple is 2 times the death benefit, and as a result this rider is sometimes referred to as double indemnity. An accidental death is one that occurs as a result of an unexpected violent or traumatic event. To qualify for the AD benefit, the death must occur within a fixed time after that event, e.g., 1 year. The AD rider typically excludes deaths resulting from suicide, self-inflicted injuries, war, or the commission of a crime. Only deaths resulting from accidents are covered. deaths resulting from sudden illnesses are not. Sometimes it may be difficult to determine if the death was caused by an accident or natural causes. In this case, a detailed autopsy and analysis of the circumstances leading to death would be required. Example: Janet had a $250,000 whole life insurance policy with a rider that doubles her death benefit for accidental death. She was found dead at the wheel of her car after it struck a concrete bridge. Her autopsy showed that she suffered a mild heart attack, which likely contributed to the accident, but that ultimately she died as a result of injuries sustained in the crash. Janet's beneficiary will receive death benefit proceeds of $500,000. However, if the autopsy had shown that Janet had died instantly from a massive coronary event, her beneficiary would likely only receive the original $250,000 death benefit. AD rider coverage may be limited to certain ages, even if the base policy is not subject to the same limitations. For example, the policyholder may have to apply for AD coverage before the life insured reaches a certain age, such as 55. The AD coverage may only continue until the life insured reaches a certain age, such as 60. The AD coverage may be reduced once the life insured reaches a certain age, such as 65. AD benefits are often packaged along with accidental dismemberment benefits, which are discussed separately in the section Supplementary Benefits. If the rider offers coverage for both accidental death and accidental dismemberment, it is called an accidental death and dismemberment AD&D rider. 5.1.4 Guaranteed Insurability Benefit GIB rider. A guaranteed insurability benefit GIB rider gives the policyholder the option to buy additional life insurance coverage in the future without providing proof of insurability. The premiums for the additional insurance will be based on the attained age of the life insured at the time of the addition, but will assume that his health remains the same. A GIB rider is very useful for those who currently do not have a large insurance need, or who cannot currently afford a larger amount of insurance, but expect they will want to increase their coverage in the future. By adding a GIB rider to a term or permanent policy now, they are guaranteed the right to increase their coverage even if their health declines. Example: Doug recently got engaged, and he and his fiancée Noma plan to have several children. Doug is only 25 and his cash flow is tight, but he knows that he will need a fair amount of insurance protection once they start their family. He purchased a 10-year $300,000 term policy now, along with a GIB rider that will allow him to increase his coverage by up to $20,000 each year. GIB riders normally include a number of restrictions, such as the option to increase the coverage may only be permitted at certain times, such as within 1 month of each policy anniversary. The amount of each increase may be limited to a specific dollar amount or percentage of the original face amount. The total increase may be limited to a specific dollar amount or percentage of the original face amount. The number of times the option can be exercised may be limited, such as 5 times over the duration of the contract. The option to increase coverage may only be available until a certain age, such as 50. 5.2 Supplementary Benefits. Benefits in addition to the death benefit. Supplementary benefits are those that may be available before the death of the life insured. They may or may not affect the death benefit that is paid upon the death of the life insured and are discussed in the following order. Accelerated death benefits. Accidental dismemberment benefit. Waiver of premium for total disability benefit. Parent payer waiver benefit. 5.2.1 Accelerated death benefits. When accelerated death benefits are added to a life insurance policy, the insurance company will pay out a portion of the death benefit prior to death of the life insured, if certain conditions are met. Accelerated death benefits are sometimes also referred to as living benefits. There are two types of accelerated death benefits, discussed below. 5.2.1.1 Terminal illness, TI, benefit. A terminal illness, TI, benefit allows the policyholder to apply for an advance on the death benefit. If the life insured has been diagnosed with a terminal illness that is expected to result in death within a fixed period of time, such as 1 year or 24 months, the request must be supported with a diagnosis and prognosis made by a qualified physician. Many insurance companies build the TI benefit right into their insurance policies. If this is the case, the policyholder does not have to pay an extra premium. Some insurance companies will even extend this benefit on compassionate grounds, even if it is not a contractual obligation. The TI benefit is usually restricted to a maximum amount, which may be expressed as percentage of the original face amount, ranging from 25% to 75%, and/or a dollar limit, e.g., 50% of the face amount to a maximum of $50,000. The TI benefit is payable to the policyholder, regardless of who is named as the beneficiary of the life insurance policy. If the beneficiary designation is irrevocable, the policyholder will have to obtain the beneficiary's permission before applying for a TI benefit. Because it is an advance of the death benefit, and death benefits are generally not taxable, TI benefits received by the policyholder are tax-free. The TI benefit reduces the death benefit paid upon the death of the life insured. Some insurance companies structure the TI benefit as a loan at a fixed rate of interest, where the loan is secured by the death benefit. In this case, the death benefit will be reduced by the loan amount plus cumulative interest. Example: William has a $500,000 term life insurance policy on his own life, with his wife, Alyssa, named as the revocable beneficiary. He bought the policy to help Alyssa maintain the family's standard of living if he died prematurely and the family no longer received his employment income. The policy provides for a terminal illness benefit of up to 25% of the death benefit, to a maximum of $100,000. Unfortunately, William was recently diagnosed with a terminal form of cancer, and he is no longer able to work. His oncologist has told him that he will likely die within 6 to 12 months. Alyssa has reduced her work hours to help care for William and to spend more time with him. To help compensate for their loss of income, William applied for, and received, a non-taxable terminal illness benefit of $100,000. When he dies, Alyssa will receive a death benefit of $400,000, which is the original face amount of $500,000 minus the TI benefit of $100,000. 5.2.1.2 Dread disease, DD, benefit, aka critical illness or C benefit. The dread disease, DD, benefit allows the policyholder to receive a benefit if the life insured is diagnosed with one of the conditions specified by the contract. The life insured does not have to be in danger of dying as a result of the condition, but the diagnosis must be supported by a qualified physician. The conditions covered will vary with the insurance company and the contract. Most policies will cover the big 4 inches, heart attack, stroke, coronary bypass surgery and life-threatening cancer, but many policies cover other conditions as well. In fact, the number of covered conditions may be as high as 25 or even more. The policyholder should review each policy carefully, to understand what is covered and what is not. The DD benefit is usually paid out as a lump sum, once the life insured has survived for a specified period of time after the diagnosis, such as 30 days. Because it is an acceleration of the death benefit, it is not taxable. Example: Scott has a $500,000 whole life insurance policy that includes a $100,000 dread disease benefit. He recently suffered a stroke that has left him almost fully paralyzed. Provided that he survives at least 30 days following the stroke, he can apply to receive the DD benefit of $100,000. The conditions under a DD benefit may be similar to those covered under an individual critical illness insurance policy. In fact, the dread disease benefit is sometimes referred to as a critical illness benefit. This C-like coverage may allow the policyholder to save money compared to buying separate life and C policies. The terminology used by various life insurance companies is often inconsistent and can be confusing. If a life insurance policy uses the term critical illness benefit or critical illness rider, the policyholder should read the terms of coverage carefully. If the amount paid out when the insured suffers a covered condition reduces the death benefit, the policy is offering an accelerated death benefit, in the form of a dread disease, DD, benefit. If the amount paid out when the insured suffers a covered condition does not affect the death benefit, i.e., it is paid in addition to the death benefit, it is not an accelerated death benefit and is likely a critical illness rider for which an additional premium must be paid. 5.2.2 Accidental dismemberment benefit. The accidental dismemberment benefit is usually found coupled with the accidental death, AD, benefit discussed earlier in the section Accidental Death, AD, rider. Together they form the Accidental Death and Dismemberment, AD&D, rider. An accidental dismemberment benefit is a lump sum amount that will be paid if the life insured loses a specific body part or body function as a result of an accident. The losses, and the resulting lump sums, that are payable as a result of each loss are typically laid out in a schedule of loss. The accidental dismemberment benefit will only be paid out if the loss occurs as a result of an unexpected violent or traumatic event, within a fixed time, e.g., 1 year, of that event. Losses incurred via self-inflicted injuries, war or the commission of a crime are generally excluded. 5.2.3 Waiver of premium for total disability benefit. Under the waiver of premium benefit, the insurance company will waive the premiums on the life insurance policy, including premiums for any riders or supplementary benefits, if the life insured becomes totally disabled. 11 The definition of total disability varies with the policy. For example, total disability might be defined as the life insured being unable to carry out his regular employment for the first 2 years of disability, and unable to do any other job thereafter for which he is reasonably qualified by education, training or experience. While premiums are being waived, benefits continue to accrue under the policy. This means that dividends will continue to be paid. If it is a participating policy, cash values may continue to grow. And all riders and supplementary benefits remain in force. 5.2.3.1 Waiting period. Premiums will only be waived once the life insured has been disabled for the waiting period specified in the policy. Some policies provide for a retroactive waiving of premiums to the start of the disability, while others only waive premiums that come due after the waiting period. has expired. 5.2.3.2 Renewable or convertible term policies. If the base policy is a renewable term insurance policy, then the premiums will continue to be waived after renewal. If the base policy is a convertible term insurance policy, at the end of the term the policy will be converted to a whole life policy, and premiums will continue to be waived for life, or as long as the life insured is disabled. 5.2.4 Parent, payer waiver benefit. The parent waiver benefit, if the life insured is the policyholder's child, or payer waiver benefit. If the life insured is someone other than the policyholder's child, operates much like the waiver of premium benefit that was just discussed, with three notable differences. Depending on the policy, premiums may be waived upon the policyholder's death, as well as upon his total disability. Because the policyholder is not the same person as the life insured, the policyholder will have to provide proof of insurability for himself as well as for the life insured. If the life insured is a child, some policies will state that premiums will be waived until that child reaches a specified age. Example: Anwar is the primary income earner in his family. His wife Anya currently cares for their 3 children, who are all under the age of 5. He has a $1 million whole life insurance policy on his own life. He also has a $300,000 term life insurance policy on Anya's life because he knows that he would have to hire someone to care for their children if she were to die. He is the policyholder. He has added a waiver of premium for total disability benefit to the policy on his own life, and a payer waiver benefit to the policy on Anya's life, to ensure that both policies will remain in place if he becomes totally disabled. 5.3 Using riders and supplementary benefits to customize coverage. A policyholder can add riders and supplementary benefits to his base insurance policy to customize or enhance the coverage. This section explores some of the things a policyholder should consider when determining if these extras are appropriate for him. 5.3.1 Cost of coverage. Each rider or supplementary benefit has a cost associated with it, and in most cases this results in an additional premium for the policyholder. A few of the benefits, such as the terminal illness benefit or the waiver of premium upon total disability benefit, may be built into the base policy, but the policyholder is still paying for those benefits through his premiums for the base policy because the insurance company will have factored those costs into them. Sometimes the coverage provided by a rider or supplementary benefit is also available as a standalone product, e.g., a term insurance rider or critical illness benefit. Usually the coverage via rider or supplementary benefit will be cheaper than the standalone product because only one policy fee will be charged. The insurance company may also have lower underwriting costs because they can use the same medical information for both products. 5.3.2 Value of coverage. Of course, a rider or supplementary benefit only has value to the policyholder if it provides the protection he needs, at a reasonable cost. Consider the accidental death, AD, benefit. Is the policyholder's need for coverage going to be different if the life insured dies from natural causes than if he dies as a result of an accident? The tax liability upon death is going to be the same, and the survivors are going to have the same income needs regardless of how the life insured dies. If an insurance needs analysis shows that insurance protection of $500,000 is needed upon death, should the agent only recommend coverage of $250,000 in the base policy, plus an AD rider that would pay double the benefit if the life insured dies from an accident? Generally, the answer would be no. The full need of $500,000 should be covered regardless of the manner of death. However, if the policyholder cannot afford the premiums for a $500,000 policy, a $250,000 policy with an AD benefit might be a good compromise. The policyholder also needs to determine if it is coverage he can count on, so he should consider any limitations or exclusions that apply to the riders or supplementary benefits, as discussed below. 5.3.2.1 Limitations. The policyholder should be aware of what conditions would trigger payments under a rider or supplementary benefit, and what the limits on those payments would be. For example, under the accidental death (AD) rider, what is considered to be an accidental death, and what time limits are involved? Under a family coverage rider, when is a child eligible for coverage, and when does that coverage cease? Under a guaranteed insurability benefit, GIB, by how much can the coverage increase and when are those increases allowed? What is the maximum amount that can be added under a paid-up additions, PUA, rider? Which health conditions are covered under a critical illness, C, benefit? 5.3.2.2 Exclusions. The policyholder should also be aware of those conditions under which payments would not be made under a rider or supplementary benefit. For example, accidental death and dismemberment. AD&D benefits may not be paid if the death or dismemberment occurred as a result of self-inflicted injuries, during the commission of a crime, or as a result of war. These same exclusions often apply to the disability income, DI, benefit, the waiver of premium for total disability benefit, and the parent waiver benefit. 5.3.3 Differences between companies. The death benefit provided by life insurance operates the same way across insurance companies. If the life insured dies, the death benefit is paid, less any outstanding policy loans. The amount of the benefit and the way the benefit is triggered is pretty black and white, without room for interpretation. However, the various riders and supplementary benefits that can be added to a life insurance policy vary greatly between companies, and even between life insurance products issued by the same company. Examples. Black Small Square Elias decided to take Company A's insurance policy because the waiting period imposed for the waiver of premium benefit is 3 months and not 6 months as imposed by some other insurance companies. Black Small Square Jackson would like to obtain the maximum dread disease, DD, benefit possible. He compares companies A and B. He decides on Company B because it provides a DD benefit of 50% of the face amount as opposed to 25% provided by Company A. Black Small Square For family history reasons, it is very important for Cindy to find a DD benefit that covers Alzheimer's. Company B does not, but she is happy to see that Company A does. So when policyholders are comparing life insurance policies between companies, they should also pay close attention to the terms and conditions of the riders and supplementary benefits. 5.4 Advantages and disadvantages of riders and supplementary benefits. The advantages and disadvantages of riders and supplementary benefits are summarized. Advantages and disadvantages of riders and supplementary benefits. Advantages can be used to customize coverage to meet policyholders' unique needs. Some benefits may be cheaper when acquired via a rider or supplementary benefit than when acquired as a standalone policy. Conversion to individual standalone coverage without proof of insurability may be possible for term insurance riders. may give the policyholder access to higher coverage later, without providing proof of insurability for GIB and PUA riders, while allowing him to pay for a lower amount of coverage now. Disadvantages. Additional premiums are usually required. There may be limitations and exclusions on coverage. Coverage expires when the base policy expires. Depending on the benefit, separate underwriting on the life insured and the policyholder may be required. Chapter 6. Group Life Insurance. Competency Component. Analyze the available products that meet the client's needs. Competency Subcomponent. Analyze the types of contracts that meet the client's needs. 6. Group Life Insurance. Group insurance policies can provide a variety of benefits that are often packaged together, including medical and dental benefits, disability benefits and life insurance. This chapter concentrates on life insurance provided through a group insurance plan. The remaining group insurance benefits are covered in the accident and sickness insurance module. 6.1 How group life insurance works. Group life insurance is coverage that is offered by a plan sponsor to a group of people who have some form of common association with that sponsor. 6.1.1 What constitutes a group? Almost any group that has a sufficient number of people with a common characteristic can be insured under a group life insurance plan. For example, group life insurance plans may be available to all employees of a certain employer, executives and managers of a certain employer, alumni from a specific university, members of an occupational association, members of a business association, members of a retail association. Example: Helen is a university graduate with an engineering degree, and she is registered as a professional engineer with an occupational association. She is self-employed as a consultant and is a member of her local chamber of commerce. She has also purchased memberships with 2 retail associations. Because she is self-employed, she cannot obtain life insurance through her employer. However, she frequently receives invitations to apply for group life insurance through the university's alumni association and the other associations. 6.1.2 Policyholder. The policyholder of a group life insurance plan is the business or organization that enters into a contract with an insurance company to provide life insurance coverage to the members of its group. The policyholder is often referred to as the plan sponsor. 6.1.3 Master Contract. A group life insurance plan is governed by a master contract between the plan sponsor and the life insurance company. There is no direct contract between the life insured and the insurance company. This means that the plan member has no control over the contract beyond naming the beneficiary and potentially buying additional optional coverage if the plan permits. Example: Derek suffers from a health problem that will not allow him to buy life insurance. His employer offers a group life insurance plan with $100,000 of coverage for which he is eligible despite his medical condition. Because the group member is not the policyholder, he does not get a copy of the master contract. However, all of his benefits and rights under the contract will be described in a benefit booklet, which he will receive upon joining the plan. 12. 6.1.4 Group Membership. A group plan member is a person who is insured under the group plan's master contract. To obtain coverage under a group life insurance plan, the plan member must meet the eligibility criteria that define the group, as set by the plan sponsor. If the plan is sponsored by a membership association, e.g., an alumni association, professional association, chamber of commerce, the person generally has to be a current association member. in good standing to obtain coverage under the group life insurance plan. For these types of group plans, membership in the group plan is optional and the member has to apply for coverage. Group members generally must maintain their membership in the sponsoring organization to continue coverage over time. Some plans give the member an option to convert to individual term or permanent coverage if they terminate their association membership, as discussed in the section Conversion Privileges. If the group life insurance plan is sponsored by an employer, new employees are generally eligible to become members of the plan upon satisfying the group's probationary period, which is the length of time they must work for that employer before they are eligible for coverage. The probationary period, which is often in the order of 3 months, may also be referred to as the waiting period. Some employers automatically enroll employees in the group life insurance plan as soon as they have satisfied the probationary period. Other employers give the employee the option of becoming a plan member, particularly if the plan requires employee contributions. If membership is optional, the employee usually has a limited period of time called the enrollment period, which occurs after the probationary period, during which time he can enroll in the group plan and obtain life insurance coverage without providing any evidence of insurability. 6.1.4.1 Actively at Work requirement. For employer-sponsored group plans, one additional requirement is that the employee must be actively at work on the day his coverage under the group plan starts. If enrollment is optional and the employee decides to enroll in the plan partway through the enrollment period, he must actually be at work before coverage will commence. If he is away from work due to illness or vacation, his coverage will not begin until he returns to work. 6.1.4.2 Membership Classes. The amount of coverage available under a group life insurance plan is generally determined the same way for everyone within that group, as discussed in the section Schedule of Benefits. However, some employer-sponsored group plans may have more than one membership class under a single group plan, with different amounts of coverage for each class. Example: the Deaf Company, manufacturer of kitchen cupboards, sponsors a group insurance plan for its employees. The plan provides a death benefit equal to 1 times salary for all full-time factory floor employees, and 2 times salary for all salaried managerial staff. 6.1.5 Premiums. The premiums for group life insurance are based on the makeup of the group as a whole, and not the specifics of each individual. For example, the life insurance company might charge 20 cents for every $1,000 of coverage, and that rate will apply to each person in the group, regardless of that person's age, gender or smoking status. However, the insurance company will usually recalculate the premium every year to reflect changes in the group's demographics over time. For example, if the group's average age increases, the premiums per member will likely increase as well to reflect the greater risk of death. Most group life insurance plans require the employer to cover at least 50% of the premiums themselves, but some employers choose to pay the full amount if the group plan is contributory, i.e., if the employees must cover a portion of the premiums, the employer remits the full amount of premiums to the insurance company, and then deducts the employee's contributions directly from their pay. 6.1.5.1 Tax treatment for employer. If an employer pays some or all of the premiums for a group life insurance plan, it can deduct those premiums as a business expense. 6.1.5.2 Tax treatment for employee. If an employer pays some or all of the premiums for a group life insurance plan, those premiums are considered to be a taxable benefit for the employee. Any premiums paid by the employee are not deductible to either the employer or the employee. The premiums paid by the employee via payroll deduction are taken from his pay. Example: Amy is a member of her employer's group life insurance plan. The annual premiums for Amy's participation in the plan amount to $500, and the employer pays 60% of these premiums, or $300. This results in a taxable benefit of $300 for Amy, which will be added to her annual income. The employer also deducts $200 from her pay to cover her share of the premiums. Regardless of who pays the premiums, any death benefits paid out under a group life insurance plan are not taxable to the employee, his estate, or the beneficiary of the policy. 6.1.5.3 Sales tax on premiums. Like individual life insurance premiums, premiums paid under a group life insurance plan are subject to a provincial insurance premium tax, which ranges from 2% to 5% of life insurance premiums, depending on the province. This provincial insurance tax is usually built right into the price quoted by the insurance company. However, unlike individual life insurance premiums, premiums paid under a group life insurance plan are also subject to provincial retail sales tax in some provinces, as follows: 13.8% in Ontario, 9% in Quebec, 7% in Manitoba. In addition, GST, HST is charged on any administrative fees associated with a group life insurance plan. 6.2 Group term insurance coverage. With individual life insurance, the policyholder has considerable freedom when deciding on the amount of coverage to purchase. Under a group life insurance plan, the coverage is restricted by the terms of the plan. All members of the plan receive a prescribed amount of base coverage, i.e., the coverage that is automatically provided for each member of the plan. Depending on the plan, they may or may not be able to buy additional optional coverage. Most group life insurance takes the form of yearly renewable term insurance, particularly for the base coverage. 6.2.1 Schedule of benefits. The base level of coverage provided by a group insurance plan is usually prescribed by a schedule of benefits that is part of the master contract. If the group plan has different membership classes, then a different schedule of benefits will apply to each class. The schedule of benefits usually takes one of the following formats: earnings multiple, flat rate, length of service, combination. These are explained in more detail below. 6.2.1.1 Earnings multiple. The most common schedule of benefits is an earnings multiple schedule, which provides coverage equal to a multiple or fraction of the member's base salary, i.e., excluding bonuses or overtime. Coverage provided under an earnings multiple schedule may be limited to a maximum specified by the plan. 6.2.1.2 Flat rate. Under a flat rate schedule, every group member receives the same dollar amount of life insurance coverage, regardless of their position, salary or wage. Flat rate benefit schedules are often used by unionized groups that cover employees who earn an hourly wage. 6.2.1.3 Length of service. Some older plans may be based on length of service to the employer. They were intended to reward long-serving employees. However, this type of schedule is rarely used today. 6.2.1.4 Combination. Some employers opt for a combination schedule that incorporates several factors, such as earnings and position. For example, a schedule of benefits may provide an earnings multiple benefit to salaried employees, and a flat rate to hourly employees. 6.2.2 Coverage maximums. Most group life insurance plans place a cap on the amount of coverage for any single plan member, particularly when coverage is a multiple of earnings for highly paid employees. 6.2.3 Reductions for older or retired group members. Recall that the risk of death generally increases with age, and thus the cost of insurance also increases with age. To keep costs reasonable for the group as a whole, the plan's schedule of benefits may specify reduced coverage for older or retired members. Depending on the plan, the reduced coverage may be determined as black small square a fixed percentage of pre-retirement coverage, black small square a fixed dollar amount, black small square a gradual decline each year until the specified minimum is reached. Example: Carl is a member of his employer's group life insurance plan, which provides a base benefit of $100,000. He plans to retire next year, when he turns 60 years old. At that time, his coverage will drop to 50% of the base coverage. At age 65 it will drop to 25% of the base coverage, and at age 70 coverage ceases completely. 6.2.4 Optional additional coverage. In addition to the base coverage that is provided to all group members, some group plans allow members to purchase additional coverage. This allows the member some ability to customize the coverage to his unique needs. The member must be enrolled in the plan's base life insurance plan before he can buy the additional coverage. Usually the group member will have to provide evidence of insurability when applying for the additional coverage, because the ability to choose the coverage amount creates the potential for adverse selection, also known as anti-selection. Adverse selection refers to the phenomenon where someone who is at greater risk, or who perceives himself to be at greater risk, is more likely to buy insurance to cover that risk, and is more likely to make a claim than the average person within the group. However, some group plans allow the member to buy additional coverage without providing evidence of insurability if they do so within a specified period of time, e.g., within 60 days of being eligible for group life insurance. This prevents the plan member from waiting until he experiences signs of illness to buy the additional coverage, which is an example of adverse selection. While the employer usually pays at least 50% of the premiums for the group plan's base. 6.2.4.1 Term coverage. The majority of this additional coverage takes the form of term life insurance. It is usually available in multiples of fixed units, e.g., $25,000 per unit. Members can buy as many additional units as they want, up to a maximum. Members cannot buy partial units. The total amount of coverage, base coverage plus additional coverage, is usually subject to an overall maximum amount. Example: Mario is 55 years old and he recently started a new job. He was automatically enrolled in the company's group life insurance plan last week, which covers him for $75,000. He just took out a new mortgage for $200,000, and he would like to add $200,000 of life insurance to cover this debt if he dies. Because of health issues, individual insurance would be very expensive, assuming he could even get coverage. However, his group life insurance plan allows members to buy up to 10 units of additional term insurance coverage, where each unit is $25,000. As long as they apply for this coverage within 60 days of joining the plan, no evidence of insurability is required. Thus, Mario can take advantage of the group life insurance plan to get the coverage he needs at a more affordable cost. Some plans extend this optional coverage to the member's spouse, with the same coverage units and maximums. This is separate from the coverage that may be available on the spouse under a dependent coverage provision, as discussed in the section Dependent Life Coverage. 6.2.4.2 Permanent Coverage. In rare cases, the optional coverage may include some type of permanent life insurance, such as whole life. However, permanent life insurance is more commonly an option upon policy conversion, as discussed in the section Conversion Privileges. 6.3 Dependent Life Coverage. Most group life insurance plans give members the option of buying life insurance coverage on their dependents, as long as they place this coverage within a short time of joining the plan, e.g. 60 days, they will not have to provide proof of insurability for those dependents. If a member's marital status changes, some plans allow the member to place coverage on the dependents without proof of insurability as long as it is done within a specified period of time. Because dependent coverage is optional, the principle of adverse selection applies. A member is more likely to take advantage of the dependent coverage if that dependent is a poor insurance risk. As a result, premiums for dependent coverage are often higher than premiums on an independent single life policy. 6.3.1 Definition of dependent. The definition of dependent for the purpose of group life insurance may vary with each group plan, but it typically includes the plan member's spouse or common law partner, includes both opposite sex and same-sex relationships, the plan member's children, if they depend on the member for financial support and they are between the ages of 14 days and an upper limit, often 18, 19 or 21 years of age. Coverage applies to biological, adopted and step-children. Extended coverage may be available past the specified age as long as the child continues to attend school full-time, up to a maximum age, usually between 23 to 25 years of age. If the child is disabled and unable to work, coverage may be available indefinitely. In many group plans, dependent coverage applies to all of the members' dependents, regardless of the number of dependents. Example: Chuck and Paul both work at the same company, and they are both covered for $200,000 under their employer's group life insurance plan. Chuck is married, but he and his wife do not have any children. Paul has a wife and 2 young children, and they expect a third child in a few months. Chuck and Paul both opted to buy the optional dependent coverage offered by their group plan. Despite the difference in the number of their dependents, Chuck and Paul will pay the same premiums. Also, Paul's newborn will automatically be covered under the plan after reaching 14 days of age. However, some group plans require the plan member to apply and pay for separate coverage for each eligible dependent. 6.3.2 Death Benefit Amount. The death benefit under dependent life coverage is quite modest compared to the coverage on the member's own life or the optional spousal coverage available under some plans. While the actual amount will vary with the policy, dependent coverage is usually in the range of $5,000 to $20,000 on the spouse's life, with 50% of this amount on the life of each dependent child. 6.3.3 Premiums. Premiums for dependent life insurance are usually the same for each group plan member, regardless of his age or number of his dependents. However, some group life insurance plans do require a separate premium for each dependent. Because the amount of coverage is so low, the annual premium is quite small, e.g., dependent life insurance that covers all children for $10,000 might cost in the order of $2 per month. 6.4 Survivor income benefits. Some group life insurance plans also provide a monthly survivor income benefit in addition to a death benefit when a group plan member dies. The survivor income benefit is normally an optional benefit that can be purchased by the plan member. 6.4.1 Beneficiaries. The survivor income benefit is normally payable to the plan member's surviving spouse or common law partner, until that person reaches age 65, remarries or dies. Survivor income benefits may also be payable to the plan member's surviving children, until they reach a certain age, e.g., until age 21. This duration may be extended for children who are attending school full-time. Some plans give the plan member the option of choosing survivor income benefits that are only payable to the surviving children. 6.4.2 Benefit amount. While the exact amount will depend on the group plan, the survivor income benefit is normally expressed as a percentage of the group member's monthly salary just prior to death. Example: a group life insurance plan offered by University ABC allows plan members to buy coverage that will pay monthly survival income benefits equal to 25% of the member's monthly basic earnings to the surviving spouse, plus 5% of monthly basic earnings to each surviving child. Some plans call for higher benefits to be paid to the surviving children if the plan member's spouse predeceased him, i.e., if the children were orphaned by the plan member's death. Survivor income benefits may be subject to a monthly, annual or cumulative cap, depending on the plan. 6.5 Accidental death and dismemberment, AD&D. Group life insurance plans often provide accidental death and dismemberment, AD&D, benefits. Under the accidental death portion of AD&D coverage, the insurance company will pay an extra benefit, over and above the regular death benefit, if the plan member dies as a result of an accident. This extra benefit is usually equal to the basic death benefit. Under the accidental dismemberment portion of AD&D coverage, the insurance company will pay a lump sum if the plan member loses a specific body part or body function as a result of an accident. The lump sum is usually equal to, or a fixed percentage of, the basic death benefit, depending on the extent of the loss. This is covered in more detail in the Accident and Sickness Insurance Module. 6.5.1 Basic versus voluntary AD&D. Some group life insurance plans automatically provide AD&D coverage to plan members. This is referred to as basic AD&D. The amount of basic AD&D benefits is usually tied to the benefit otherwise payable upon death. Other plans give plan members the option of buying AD&D coverage. This is referred to as voluntary AD&D. Like optional life insurance coverage, voluntary AD&D is usually purchased in multiples of a specific unit, e.g., $10,000 or $25,000, and the member can buy multiple units up to a maximum amount. Example: Charlotte's group life insurance plan provides a death benefit equal to her annual salary, or $120,000. She also purchased 4 units of voluntary AD&D coverage, at $25,000 per unit. If she dies as a result of an accident, her beneficiaries will receive a total of $220,000, calculated as $120,000 plus 4 times $25,000. However, if she dies as a result of an illness, her beneficiaries will only receive $120,000. Because AD&D benefits are only payable as a result of an accident, evidence of insurability is not required. 6.5.1.1 Coverage for dependents. Some group insurance plans also allow the member to buy AD&D coverage for his spouse and/or children. Usually, coverage for the dependents is a fixed percentage of the coverage on the plan. Member himself. 6.5.2 Exclusions. AD&D benefits will only be paid if the loss occurs as a result of an unexpected violent or traumatic event. However, losses due to certain activities or events are often excluded. Common exclusions include losses that result from self-inflicted injuries, war, active service in the armed forces, commission of a crime by the insured, driving while impaired, piloting a non-commercial aircraft. 6.5.3 Overall limits. If voluntary AD&D coverage is available in multiples of a fixed unit, the group plan will typically place an overall limit on the number of units that a group member can buy, e.g., units of $10,000 to a maximum of 10 units or $100,000. 6.6 Conversion privileges. A member of a group life insurance plan generally has the right to convert some or all of his group life insurance coverage to individual coverage with the same insurance company, without providing proof of insurability, if he leaves the plan because he retires or changes employers. He is no longer a member of the sponsoring organization. The plan itself is terminated. Example: Derek's employer is experiencing financial hardship and it has terminated the group plan to cut costs. While Derek may be able to convert his coverage to an individual policy, see the section Conversion Privileges, it will still be considerably more expensive than the group insurance coverage, and he will have to pay the premiums himself. 6.6.1 In Quebec. The Quebec Act respecting insurance includes specific rules that protect a group member's rights. When he leaves a group life insurance plan, or when the master contract expires or is cancelled. 6.6.1.1 Leaving the plan. The Quebec Act respecting insurance 14 specifies that if a group life insurance plan member leaves the group prior to age 65, he must be given the option of converting some or all of his life insurance coverage into the same amount of individual insurance. This also applies to any spousal or dependent life insurance coverage that existed under the group plan. The amount of insurance on the participant's life that is eligible for conversion must be at least $10,000 and may not exceed $400,000. In addition, the amount of dependent life insurance that may be converted must be at least $5,000 for his spouse and for each dependent, without exceeding the amount of insurance on the life of those persons on the conversion date. The plan member must be allowed to exercise these conversion rights for at least 31 days after leaving the group, without providing evidence of insurability for himself, his spouse or dependents. The group insurance will remain in force during that 31-day period, or until it is converted into individual insurance. The member must be given the following options upon conversion: coverage that is comparable to that provided by the group insurance contract as to the amount and the term, or individual life insurance for 1 year, providing protection comparable to that provided under the group insurance contract, but convertible at the end of the year into permanent protection. 6.6.1.2 Master contract terminates. If the master contract expires and is not replaced, or if it is replaced with a contract that provides for a lesser amount of insurance, any plan member who has been insured under the expired contract for at least 5 years must be given the option of converting all or a part of his coverage into individual life insurance within 31 days of expiry of the master contract. The amount of insurance eligible for conversion upon expiry of the master contract must be at least $10,000 or 25% of the amount of the member's life insurance, whichever amount is greater. 6.6.2 In the rest of Canada. While conversion privileges are not governed by provincial laws in the rest of Canada, the industry does follow the guidelines set forth by the Canadian Life and Health Insurance Association 15. Clear. These guidelines provide similar protection, in that, on or before reaching age 65, a plan member should be able to convert up to $200,000 of the group life coverage on his own life to individual insurance without providing proof of insurability. At a minimum, he should have the option of choosing yearly renewable term, or term to age 65. The plan member must apply for the conversion within 31 days of the termination of his coverage under the group life insurance plan. Note that unlike Quebec, the CLHIA guidelines are silent on conversion privileges for coverage on the plan member's spouse or other dependents. In practice, most group insurance plans that provide optional group coverage on the life of the member's spouse extend the same conversion privileges to that coverage. However, dependent coverage is often not convertible. 6.6.3 Premiums upon conversion. When a group member leaves the plan and converts his group life insurance to individual coverage, he should compare the premiums for that coverage to the premiums for a brand new individual policy. In the case of the converted policy, adverse selection applies. In other words, a person who is otherwise uninsurable or who has a higher risk of dying is more likely to convert his group coverage to individual coverage. Also, the insurance company does not get the chance to perform its normal medical underwriting that would apply to a brand new applicant. These factors increase the insurance company's risk, which results in higher premiums on the converted coverage. 6.7 Replacement contracts. Employers are always looking for ways to reduce the cost of the benefits they provide to their employees, or to enhance those benefits without increasing costs. This means that they sometimes change group insurance providers and replace existing contracts with new ones. The clear guidelines are designed to ensure that a group life insurance plan member does not lose coverage solely because the plan sponsor has decided to change insurers, or because he was not actively at work at the time of the change. However, if there were several classes of membership under the old plan, e.g., management, clerical and labor, and one of those classes is not covered by the replacement plan, then members of the old plan who fall into that class would not be entitled to coverage under the new plan. 6.7.1 Benefit amounts. As long as the plan member is eligible for insurance under the terms of the replacement contract, then he should be covered for the same amount under the replacement contract, subject to the maximums of that replacement contract. 6.8 Disabled members. Group life insurance policies typically include a waiver of premium provision, which stipulates that if the member is disabled, the insurance company will waive the premiums for a specific period of time specified in the contract, while still providing coverage. In fact, CLHIA guidelines require that the premium must continue to be waived and coverage continued even if the employer terminates the group contract with the insurance company. 6.9 Group creditor insurance. Financial institutions often encourage their borrowers to obtain life insurance to cover the debts they have with that financial institution. This most commonly occurs with mortgages, but can apply to any consumer debt. While the borrowers are free to obtain that life insurance elsewhere, most lenders offer the Convenience of group creditor insurance to their customers. This is a subset of group life insurance, where the financial institution is the policyholder, and the borrowers are the plan members. Because consumers often have misconceptions about how creditor insurance works, the Canadian Life and Health Insurance Association, CLHIA, has published Guidelines 16 to help protect borrowers who purchase group creditor insurance. These guidelines require the lender to disclose the following to the borrower at the time of applying for the creditor insurance: that the insurance coverage is voluntary, and is not required for approval of the loan; that the borrower has at least 20 days after receiving the certificate of insurance to cancel the coverage and obtain a full refund; that the borrower has the right to cancel the coverage at any time. All terms and conditions that might limit, restrict or exclude coverage, such as, but not limited to, pre-existing conditions and the consequences of misrepresentation, the amount of the premium or how it is calculated, that the coverage is subject to acceptance by the insurer, any further steps the borrower must take, the insurer's obligation to notify the borrower if coverage is declined, the terms upon which coverage starts, if the application is accepted. 6.9.1 Death benefit. The amount of the death benefit payable under group creditor insurance is generally limited to the amount of the debt outstanding. If this is the case, then the death benefit decreases as the debt is repaid. 6.9.2 Beneficiary. The beneficiary of group creditor insurance is the lending financial institution, which will use the proceeds to extinguish the debt. Because the death benefit is generally limited to the amount of the debt outstanding, there is no residual benefit to the borrower's estate. 6.9.3 Premiums. Premiums for group creditor insurance are typically based on the borrower's age, within a range of 5 to 10 years, and smoking status. How these rates are applied depends on the policy and the type of loan. Mortgage insurance, for example, typically bases the premium on the original mortgage amount. It is essentially decreasing. Term insurance. The premium will not change, even as the mortgage balance, and thus the death benefit, declines over time. The premiums for creditor life insurance on a line of credit, however, tend to be based on the outstanding loan at the end of each month, or averaged over the year. 6.9.4 Additional coverage. Some group creditor life insurance providers also offer coverage if the borrower becomes disabled, suffers a critical illness, or even becomes unemployed. This protection may be provided as part of the base creditor life insurance package, or it may be offered separately. 6.9.4.1 Disability. Group creditor disability insurance will pay the lender a monthly benefit if the borrower becomes disabled and is unable to work. The amount will be the lesser of the monthly loan payment or a specified maximum. Benefits may continue as long as the borrower remains disabled, or for a limited period of time. A cumulative maximum may also apply. 6.9.4.2 Critical illness. Group creditor critical illness insurance will pay off the outstanding debt if the borrower is diagnosed with a covered illness. The benefit is paid regardless of whether the borrower can work or not. 6.9.4.3 Unemployment. Group creditor unemployment insurance will pay the lender a monthly benefit if the borrower loses his job through no fault of his own. These benefits are normally limited to a specific dollar amount or duration. Chapter 7. Taxation of life insurance and tax strategies. Competency components. Analyze the available products that meet the client's needs. Assess the client's needs and situation. Implement a recommendation adapted to the client's needs and situation. Competency sub-components. Analyze the types of contracts that meet the client's needs. Assess the appropriateness of the client's existing coverage in regards to his or her situation. Propose a recommendation adapted to the client's needs and situation. 7. Taxation of life insurance and tax strategies. Life insurance was originally designed to help people manage the financial risks associated with death. However, Canadians are increasingly using life insurance as a wealth accumulation and preservation tool, often for the purpose of creating an estate. One of the reasons it is used in this manner is the potential tax benefits it can provide. To advise their clients appropriately, agents need to have a good understanding of the tax implications of owning a life insurance policy and disposing of it. This chapter focuses on the taxation of personally owned life insurance, as well as using life insurance to manage taxes that may arise upon death. The taxation of corporate-owned life insurance is covered in Chapter 8. The booklet entitled Life Insurance Taxation Principles is a prerequisite to understanding the product-specific aspects of taxation covered in this chapter. 7.1 Key Concepts. There are several concepts that are key to understanding how life insurance is taxed, including tax-free nature of the death benefit, policy dispositions, policy gains, adjusted cost basis, ACB. 7.1.1 Tax-free death benefit. The death benefit from a personally held life insurance policy is exempt from tax. This holds true regardless of how long the policy has been in place, or how much the policyholder has paid in premiums, or even the type of policy, term, permanent, group, mortgage, etc.